President Trump continuing his criticism of Jay Powell during a CPAC speech this past Saturday. Trump stated the U.S. dollar is too strong and rate hikes are hurting the economy.
A gentleman that likes a very strong dollar in the Fed. I want a strong dollar, but I want a dollar that's going to be great for our country. Not a dollar that's so strong that it is prohibitive for us to be dealing with other nations and taking their business.
Unclear if that is an issue right now, but joining us now is Columbia Threadneedle Investment Senior Interest Rate and Currency Analyst Ed Hussainy. Ed, it's good to see you. So interesting here that the president is complaining about the strong dollar right now, because we've seen some strengthening, but it's not prohibitively strong for U.S. businesses at this point, is it?
Right. So, I mean, on a year-on-year basis, it's up, close to 10%. So, which is not nothing. It's definitely been a drag on profitability, and it has been a drag on exports. I think, interestingly, it's going to be an important transmission channel in terms of the impact that the U.S.-China relationship has on growth over the next, 12 to 18 months.
Well, if you look at what we expect to happen with the U.S.-China, we do expect there to be the announcement of a trade deal. How do you position yourself going forward if you've now got the administration also saying we want a weaker dollar? The Fed has listened, whether they say they have or haven't. They seem to have listened at the end of last year to the president, but they listen now, and how do I play that?
Right. So I would say if you look at the U.S.-China relationship, particularly the trade deal, strip out the secular issues, which is, subsidies to SOEs, intellectual property transfers, enforcement issues, which will take, as many of you guests have said, it will take many years to play out. Look at the cyclical aspects of this trade, which is, in my mind, sort of threefold. One, the existing tariff structure. I think to the extent that new tariffs will not come online, that's been pretty well priced. Existing tariffs going away is probably not as well priced. So there's probably a little bit more upside to risk on that front. To the stability of the CNY, so the renminbi essentially being pegged to the dollar and reducing risk that the Chinese will devalue it as they face domestic pressures. That probably takes a little bit of dollar upside off. And the third piece, which is probably the most important piece, is Chinese stimulus. The fact that this trade deal would potentially be done, I think, opens up room for additional fiscal stimulus coming online. And I think that, from a cyclical perspective, is probably the most important story for the second half of this year.
Ed, one of the questions we get a lot, changing gears a little bit, is around Brexit, because that has such an effect, obviously, on the pound, but also on the euro. And that U.S.-euro, relationship is one our clients like to look at or trade a lot. What do you see happening there, and what people should look for, not only in the pound, but in that derivative trade with the euro?
Sure. So to the extent that the euro-dollar exchange rate at the moment reflects, in my mind, sort of two buckets of things. First, the interest rate differential, which continues to be skewed in favor of the dollar. It's a nice positive carry trade. The second piece is the growth differential, and most importantly, growth expectation differential. That continues to be skewed in favor of the U.S. as well, even though both U.S. and Europe are coming down. European growth expectations are plummeting at this stage. And so the question is, where do we start to bottom out? Brexit, to the extent that Brexit is not fully priced, I think, in European growth expectations the way it is on the UK side, I think provides an opportunity to be short the euro as a hedge against something bad happening on the Brexit front.
So in the growth expectation, you're saying slowing the growth in Europe.
Exactly.
Even more than...
Exactly. An additional hit at a time when the cushion for errors, the margin for error in Europe is exceptionally small.
At the same time, you say if we get a resolution of the U.S.-China trade situation, you could see a bit of a benefit for Germany. But it doesn't sound like you think it'll be substantial enough to really move the needle on European growth?
I think we have to get past through some of this uncertainty in the first half of the year and start to stabilize growth. To that end, if you look at where German rates are at the moment, 15 basis points, close to touching zero a couple of weeks ago, they will look exceptionally rich. So there's probably more room for German rates to sell off into the end of the year and underperform U.S. rates in the second half if growth starts to stabilize and we get a little bit more reflation into the global economy. So from my perspective, it positions us well to be long U.S. rates, short Germany, and at the moment, long dollar, but potentially transitioning that into a short dollar position in the second half of the year.
All right. Thanks, Ed. Good to see you. Ed Hussainy is Columbia Threadneedle's Investment Senior Interest Rate and Currency Analyst.